Imagine looking at a patient's medical chart,
Yeah.
right? And you see a resting heart rate of, I don't know, 180 beats per minute.
Which is terrifying.
Yeah, exactly. It's terrifying. But then you look down, and their core body temperature is like 92 degrees.
So they're basically freezing to death while having a heart attack.
Right. You've got this cardiovascular system that is racing at this euphoric, almost dangerous speed, but alongside a metabolism that is just completely shutting down.
And that is essentially the global economy right now.
It really is. I mean, we've got a massive euphoric artificial intelligence boom happening on one side of the planet, and then a grinding, terrifying energy chokehold happening on the other.
It's a complete paradox because, we're so used to the global economy acting like a synchronized tide.
Right, like all boats rise or fall together.
Exactly. Usually the water is coming in everywhere or it's going out everywhere. You have a global expansion or you have a global recession.
But July 2026 is, well, it's defying all of those conventional rules. We're looking at a landscape that is actively being ripped apart by two massive opposing forces colliding in real time.
Yeah, and it's messy.
It is really messy. So welcome to this deep dive. Our mission today is to cut through all that exhausting daily market noise. We want to explore the central thesis screaming out from our stack of sources today.
And we really want to figure out exactly how this geopolitical energy shock in the Middle East is rapidly dividing the global economy into very clear winners and losers.
Right. We're going to examine how it has completely stalled that disinflation trend we all thought was locked in, and how it's forcing central banks into a terrifying corner.
And ultimately, and this is the part you really need to care about, how it is directly pushing up your mortgage rate.
Yeah, from the Middle East straight to your wallet. So to do that properly, without falling into the trap of just like reciting random headlines, we've got a really specific stack of institutional intelligence in front of us.
Yeah, we are leaning heavily on the International Monetary Fund's July 2026 World Economic Outlook Update.
Which is a heavy hitter.
It is.
Yeah.
But we're also integrating institutional trading desk views. We've got notes from Tickmill and JP Morgan because we want to see how the people actually moving the money are reacting to this.
Right, getting out of the theory and into the practice. And then we are taking all of that high-level macroeconomic stuff and slamming it into hard real estate data. We got numbers from Veros, Nationwide, and Capital Economics.
It's a lot of data, but it paints a really clear picture.
So I want to start right at the top with the IMF's tale of two economies. When the IMF drops a World Economic Outlook update, it's essentially the closest thing humanity has to a definitive global report card.
Yeah, it's the benchmark.
And the numbers they just released for July 2026 are startling. They trimmed global GDP growth down to 3.0%.
Which is sluggish, but, not the end of the world.
But the headline that actually matters, the number that is causing absolute sweat on the trading floors, is inflation. They revised global headline inflation upward for the third consecutive time.
Pegging it at 4.7% for the year.
Yeah, 4.7%.
And that trajectory is the real story here. Because think back to January. The IMF projected 3.8% inflation.
Right, and we were all patting ourselves in the back, thinking, okay, the worst is over, we did it.
Exactly. Then in April, they bumped it up to 4.4%, which was a warning sign. And now in July, it's 4.7%. The disinflation trend, that great comforting cooling off of prices everyone was celebrating back in early 2024, it is entirely dead.
It hasn't just paused, it is completely reversed.
Right.
But I'm struggling to square the circle, honestly. On one hand, you have 4.7% inflation, which historically just suffocates growth. But then on the other hand, you have certain pockets of the global economy putting up numbers we usually only see from, like, emerging markets during a rapid industrialization phase.
Because the global economy isn't just slowing down, it is violently fracturing.
Right. You have economies deeply tied into the AI hardware supply chain, and they are absolutely booming. The poster child here is South Korea.
Oh, the South Korean numbers are wild.
They just smashed estimates with a 7.5% seasonally adjusted annualized growth rate in the first quarter. Let's just pause on that. 7.5%.
Yeah, and we should probably clarify what that specific metric means because it sounds almost impossibly high for a developed, industrialized economy.
It really does. Break that down.
So when we say seasonally adjusted annualized growth rate, we are taking the growth that happened just in the first quarter, so the first 3 months of the year.
Okay.
We smooth out the typical seasonal blips, like the post-holiday shopping hangovers, and then we project that exact pace over a full 12 months. So it's a run rate.
But even as a run rate, that is staggering. especially considering the context of who South Korea is, economically speaking.
Right, they don't produce their own energy.
Exactly. They are a massive importer of energy. They buy their oil and gas from the Middle East. And traditional economic logic says that when oil prices spike, an energy importer like South Korea should be getting absolutely crushed.
The energy bill alone should wipe out their profit margins.
Right. So how are they growing at 7.5%?
Well, traditional economic logic didn't account for a generational technological shift happening at the exact same moment as an energy crisis.
The AI boom.
Yeah. South Korea is part of a very exclusive club alongside Taiwan, Thailand, and Malaysia. The IMF actually designates them as the top net exporters of AI-related hardware.
And we aren't just talking about software companies here. We are talking about the physical backbone of the AI revolution.
The advanced memory chips, the specialized semiconductors, the actual physical infrastructure required to build massive data centers.
So that AI export boom is generating so much inbound capital for them that it is basically acting like a massive high-performance engine.
Completely overpowering the heavy anchor of those soaring energy costs.
Okay, so if you have the hardware, you survive the energy shock. But if you aren't in that exclusive AI hardware club, the picture's pretty bleak.
It's really grim. Look at the commodity importers outside the tech loop.
Yeah, the Eurozone's growth forecast has been downgraded to a mere 1.1%. And France and Japan were both downgraded to 0.6%.
They're suffocating.
Because they are paying the exact same elevated energy bills as South Korea, but they don't have a trillion-dollar global tech frenzy buying their exports to offset the cost.
And that is the bifurcation we're talking about. The energy shock is basically the great filter right now.
Yeah. If you have a counterweight, like AI manufacturing, you thrive. If you don't, your industrial base slowly grinds to a halt.
And then, of course, there is the United States.
Right, which the IMF shows sitting in a completely unique, heavily insulated position. The U.S. is holding incredibly steady at 2.3% projected growth for 2026.
Because the U.S. basically holds the winning lottery ticket for this specific weird macroeconomic environment.
Yeah, it really does. It is both a massive net energy exporter, thanks to the whole shale revolution over the last decade, and it is the absolute epicenter of the global AI investment cycle.
So the United States is functionally shielded from the direct pain of importing expensive oil because it produces its own,
while simultaneously reaping the benefits of massive domestic tech investments. I mean, you've got the hyperscalers, the Amazons, Microsofts, and Googles of the world just pouring billions into building out their domestic compute capacity.
It's the perfect storm in a good way for the U.S.
But I want to challenge this underlying narrative for a second, because it feels like we are looking at aggregate numbers and missing the disease underneath.
What do you mean?
Well, is this AI boom actually acting like a massive financial painkiller? Think about it. If you have a broken leg, but you take a heavy enough dose of painkillers, you might feel totally fine. You might even try to run on it,
Yeah.
but the bone is still broken, and eventually the leg is going to splinter entirely. So are these massive AI equity valuations and semiconductor export surges just masking the underlying economic rot being caused by this oil shock?
That's an interesting way to look at it.
I mean, if we somehow mathematically stripped away the AI hardware surge right now, wouldn't the global economy look like it's already in a deep, painful recession?
So I'd actually push back on the painkiller analogy. A painkiller just masks a symptom without treating the underlying injury, right?
Yeah.
The AI boom is actively creating real structural capital flows. It's not a painkiller. I'd say it is more like a prosthetic leg.
Prosthetic leg.
Yeah, it is actually bearing weight and keeping the global economy moving forward. However, your point about the underlying vulnerability is spot on, and it's something the IMF explicitly warns about in the fine print of this report.
How so? What did they say?
The IMF notes that if you remove the top 4 AI hardware exporting nations from the global average, the rest of the world actually came in 0.3 percentage points below the IMF's already lowered expectations in the first quarter.
Wow. Below the lowered expectations.
Oh, exactly. So the underlying economic tissue of the average global consumer and the traditional global manufacturer is highly inflamed by the cost of energy.
So the prosthetic leg of the AI boom is currently the only thing keeping the aggregate global GDP numbers looking healthy.
That's exactly it.
Which brings us to the most terrifying part of this entire IMF forecast, the load-bearing assumption.
Oh yeah, this is where the math gets really shaky.
Right, because everything we just talked about, the 3.0% global growth, the U.S. staying steady at 2.3%, even that painful 4.7% inflation figure, all of it rests on a single incredibly fragile foundation.
The IMF's entire baseline projection, all of those numbers, relies on the explicit assumption that the Strait of Hormuz will begin reopening to commercial traffic by mid-July 2026.
Mid-July.
Yes. They are modeling out the rest of the global economy based on the assumption that the global petroleum index will average $89 a barrel.
$89 a barrel, based on a mid-July reopening. But, I mean, look at the reality on the ground right now. That assumption is collapsing in real time.
It's completely falling apart.
We're seeing fresh U.S. strikes on Iranian military targets, over 80 targets, including coastal radar sites and command networks. We are seeing Iran retaliate with ballistic missile strikes on bases in Jordan, Kuwait, and Bahrain.
And we have commercial vessels literally catching fire, like the Qatari flag LNG carrier, the Al Ruqayyat, getting hit in the Strait.
And to top it all off, we just had former President Trump declaring the ceasefire, quote-unquote, over before walking it back an hour later, which just sent Brent crude yo-yoing wildly around the $77 to $80 mark.
We really need to establish what the Strait of Hormuz represents physically and economically, because it's easy to just think of it as a spot on a map.
Yeah, walk us through it.
It is a narrow waterway between the Persian Gulf and the Gulf of Oman. It is only 21 miles wide at its narrowest point. And the actual shipping lanes, they are only 2 miles wide in either direction.
It is the ultimate geographic choke point.
Exactly. And before this current escalation, roughly a fifth of total global oil consumption and a massive chunk of global liquefied natural gas supplies traversed that specific waterway every single day.
And right now, commercial traffic is ground to a near halt.
Because it's not just about the physical danger of a missile strike, right? It's about the economics of shipping insurance.
Ah, the underwriters.
Right. The underwriters in London who insure these massive tankers are advising companies to pause voyages entirely. Or they are jacking up the war risk premiums so high that it becomes economically unviable to make the trip.
So the IMF's assumption of a mid-July reopening, the idea that ships are just going to magically start flowing normally again in a few weeks, it is completely detached from the geopolitical reality unfolding on the ground this week.
Completely. And what's wild is that the IMF seems to know their own assumption is shaky.
Because they buried a warning in the report.
Right. Buried in their report is an explicit warning about oil inventories that honestly reads like the setup for a disaster movie.
Because the strait has been choked off, the world has been surviving by quietly draining its emergency reserves.
Yeah. The U.S. Strategic Petroleum Reserve, the SPR, has hit a 43-year low. We are rapidly approaching a critical threshold where the math changes entirely.
The IMF uses a very specific term for this, right? A nonlinear risk.
Yes, and we need to explain the mechanics of that because it dictates everything about where oil prices could go next.
Let's break it down. What does a nonlinear risk actually look like in the oil market?
Well, when global oil inventories are healthy, a supply disruption in the Middle East causes a proportional linear price increase.
Okay, so maybe a pipeline goes down and oil goes up $2.
Right, it's manageable. But when inventories are depleted, when the tanks are essentially running on empty pace, the relationship breaks down.
Because there's no buffer.
Exactly. Even a minor new supply disruption won't just bump the price up slightly. It will cause a disproportionate, explosive, nonlinear spike in prices.
It's like driving a car. If you have half a tank of gas, hitting a massive traffic jam on the highway is annoying. You idle, you waste some gas, but you'll get home.
Sure.
But if your gas light has been on for 30 miles and you hit that exact same traffic jam, it is an absolute crisis. You are going to stall out on the highway.
That's a great analogy. And the global economy's gaslight is blinking red right now.
And we don't have a tow truck coming.
No, we don't.
And yet, and this is the part that blows my mind, look at the financial markets. Look at the equities.
The divergence is wild.
The JP Morgan trading desk notes point out this massive divergence. Emerging markets, the countries that simply cannot afford to absorb a massive energy spike, are in full panic mode. Their currencies are getting battered.
But the G10 equities seem incredibly calm.
Right. And if those unfamiliar, the G10 refers to the group of the most heavily traded industrialized economies, the US, the UK, the Eurozone, Japan. Their stock markets are holding up.
They really are.
I'm looking at this and thinking, isn't the market being dangerously complacent? How can you have burning oil tankers and stock markets sitting near all-time highs?
It is very easy to look at the G10 equity charts and assume complacency, to assume that Wall Street is just asleep at the wheel. But there is a deeper layer of market psychology happening here.
Okay, so you don't think they're complacent?
I wouldn't call it complacent. I mean, it's more like paralysis.
Paralyzed how?
Think about what a trader has to price in right now. There are ongoing, high-stakes diplomatic talks happening behind closed doors in Pakistan and Switzerland right now, attempting to salvage a memorandum of understanding and piece a ceasefire back together.
Right. The market knows these talks are happening.
So it is holding its breath, and it is pricing in the pure ambiguity of the situation.
It's a straddle.
Precisely. If a hedge fund aggressively shorts the market and prices in a total multi-year closure of the Strait of Hormuz, and then a peace deal is magically announced tomorrow morning,
They get wiped out in the relief rally.
absolutely wiped out. But conversely, if they price in peace and go long, and a major tanker sinks tomorrow afternoon, they get wiped out on the downside.
So they just sit on their hands.
Yeah, the smart money sits in this uneasy, paralyzed middle ground. They aren't ignoring the risk. They are trapped by the binary nature of it. They are waiting for a definitive signal to break the paralysis.
Wow. Okay, I want to shift gears because it is very easy to talk about geopolitics, the Strait of Hormuz, and institutional trading desks as if this is a giant board game played an ocean away.
Yeah, it can feel very abstract.
But the entire mission of this deep dive is to show you, the listener, exactly how a blocked strait in the Middle East reaches directly into your wallet and makes it harder to buy a house in your neighborhood. We need to trace the transmission mechanism.
And the transmission mechanism from the Middle East to a local mortgage is remarkably direct, even if the steps feel a bit, complicated to the average consumer.
It operates like a very rigid pipeline. Let's walk through the pipeline.
Okay.
Step one is the geopolitical shock, blocking the Strait of Hormuz, which physically chokes off the global oil supply.
Right. And step two, that physical supply choke causes oil prices to spike, or at the very least remain stubbornly elevated in that $80 to $90 range.
Because oil is the fundamental input for literally everything.
Exactly. It powers the factories, it fuels the cargo ships, it goes into the fertilizer that grows our food. So that elevated oil price bleeds into the broader economy. It forces manufacturers and shippers to raise their prices to protect their margins.
Which brings us to step three. General inflation stays sticky.
Right. The central banks have their target of 2% inflation, but the elevated cost of energy ensures that the actual inflation rate refuses to drop down to that target.
And here's where we hit the bond market, step four, which is where the magic or the horror happens.
When inflation stays sticky, bond investors get very nervous.
Explain that dynamic. Why do they care?
Because if you buy a government bond that pays you a fixed 4% interest rate every year for 10 years, but inflation is running at 4.7%.
You are actually losing purchasing power in real terms.
Exactly. Your money is buying less stuff over time, despite the interest you are earning.
So the investors demand higher returns to compensate for that inflation risk.
Yes. They start selling off bonds, which drives the price of the bonds down. And because bond prices and yields move in opposite directions, the yield, the effective interest rate the bond pays, spikes up.
Specifically, we watch the 10-year Treasury yield in the United States.
Because that is the benchmark for global borrowing. And recently, that 10-year Treasury yield has climbed to 4.30%.
Which triggers the final link in the chain, mortgages.
Right. Mortgage lenders use that 10-year Treasury yield as the baseline guide for pricing home loans.
Why the 10-year? I mean, a mortgage is usually 30 years, right?
It is. But the average homeowner moves or refinances after about 7 to 10 years. So lenders look at the 10-year Treasury yield, they add a risk premium on top of it to guarantee their own profit, and that becomes your mortgage rate.
So when the 10-year yield spikes, because bond investors are terrified of oil-driven inflation.
Your mortgage rate spikes instantly.
Wow. From a missile strike in the Middle East to an empty oil tanker to a sticky inflation report to a spiking 10-year Treasury yield straight into your monthly housing payment.
It is a merciless domino effect.
And the real estate reality we are seeing in the data right now is brutal. Let's look at the U.S. market first.
Thanks, Ref.
According to Freddie Mac, the average 30-year fixed mortgage has risen for 5 straight weeks, hitting 6.72%.
And it's not just the cost of borrowing the money that's going up.
Right. The Veros data shows that those exact same high oil prices are driving up the transportation costs for heavy raw materials.
Lumber, concrete, steel. Getting those materials to a job site is suddenly vastly more expensive, which means building new construction is more expensive.
And the pain in the housing market is truly global. It might actually be more acute outside the U.S.
If you look at the UK market, the data from Nationwide and Moneyfacts is striking.
What are they seeing?
The average 2-year fixed mortgage rate in the UK jumped a full percentage point just since early March. hitting 5.84%.
Let's put that in real dollar, or rather pound terms for a household. What does a 1% jump actually mean?
For a typical UK borrower taking out a £250,000 loan, that 1 percentage point jump adds nearly £1,800 a year in sheer interest costs.
Ouch.
Yeah. That isn't money going toward paying down the principal of the house. That is £1,800 evaporating into the ether just to service the debt.
That is a massive erosion of purchasing power for the average family. And it's directly resulting from the change in bond market expectations driven by the energy shock. But, and here's the thing that confuses a lot of people. I'm looking at these numbers. The mortgage rate's climbing. The construction costs rising, the affordability completely evaporating for the middle class. And my logical brain says the housing market should be collapsing.
We should be seeing a massive wave of price cuts.
Right. But it isn't crashing. Capital Economics is forecasting that UK house prices will basically stagnate or maybe rise a modest 1% rather than fall outright. How is that possible?
It requires a shift in how we think about market dynamics. People often assume that if a market becomes unaffordable, prices must plummet. But the housing market right now is not operating under normal conditions.
It feels like a game of musical chairs where the music has abruptly stopped, but absolutely nobody wants to stand up.
Why would they?
Right? Because everyone knows that to play the next round, to sell your current house and buy a new one, the entry fee, your new mortgage rate, is essentially doubled. So everyone just stays seated.
That is a perfect way to visualize it. The reason the market isn't snapping, the reason we aren't seeing a 2008-style collapse in nominal prices, where the actual dollar value of the homes plummets, it comes down to two massive structural factors holding everyone in their chairs.
Okay, factor number one is the supply constraint.
Right. Builders simply haven't been building enough homes to keep up with population growth for over a decade.
And as you mentioned, current homeowners refuse to sell because they do not want to give up the ultra-low, sub-3% fixed-rate mortgages they locked in years ago.
It's called the lock-in effect. If you sell your house, you lose the historically cheap debt attached to it.
And factor number two?
Factor number two is financial resilience.
Explain that, because people don't usually associate high interest rates with resilience.
Well, as Nationwide points out in their data, household debt in the UK is actually at its lowest level relative to income in 2 decades.
Really?
Yeah, around 90% of existing UK mortgage holders are on fixed-rate deals. They have a buffer.
So it's the exact opposite of 2008.
Exactly. Unlike 2008, we don't have millions of people holding subprime adjustable rate mortgages that are suddenly exploding and forcing them into foreclosure.
There is no wave of forced selling.
Right. So affordability is absolutely terrible for new buyers trying to enter the market, but the structural floor under existing home prices remains largely intact. The market just freezes.
Wait, if household debt is relatively low and nobody is forced to sell, then high mortgage rates aren't going to crash the housing market. They're just going to freeze it in carbonite.
Pretty much.
But if the housing market is frozen and inflation is stuck at 4.7%, what on earth is the Federal Reserve supposed to do? Which brings us to the ultimate crossroads and the people who have to figure out how to navigate it, the central bankers.
This is where macroeconomic theory hits a brick wall.
Let's focus on the U.S. Federal Reserve, which is now led by Chair Kevin Warsh, who replaced Jerome Powell. The Fed recently kept their benchmark interest rate unchanged at 3.5 to 3.75%.
And the dilemma they are facing is profound.
They have a dual mandate, but their primary focus right now is controlling inflation. And the only real tool they have to fight inflation is raising interest rates, right?
Right, which slows down economic demand by making it more expensive for businesses to borrow and expand and for consumers to spend.
But here is the fundamental limit of monetary policy. Kevin Warsh cannot print more oil.
No, he cannot. The Federal Reserve cannot dispatch an aircraft carrier to reopen the Strait of Hormuz.
So raising interest rates does absolutely nothing to cure a supply-driven energy shock.
Exactly. If the price of oil is high because ships can't sail, raising the cost of a car loan in Ohio doesn't solve the underlying problem.
So why not just do nothing? If I'm Kevin Warsh and I know I can't fix the oil supply, why not just sit on my hands, leave rates alone, and tell the public, look, this is a geopolitical supply issue. It's not a monetary policy issue. We just have to wait it out.
Because if they do nothing, they risk something far more dangerous than a temporary spike in energy costs.
What's worse than that?
They risk inflation psychology taking root in the minds of the public.
Okay, explain inflation psychology.
It is a behavioral shift. If businesses and consumers start to genuinely believe that 4 or 5% inflation is just the new permanent normal, they change their behavior in ways that make it a self-fulfilling prophecy.
So workers go to their bosses and demand 6% annual raises just to tread water.
And then businesses look at those higher labor costs and preemptively raise the prices of their goods to cover the future expense.
And consumers buy things today, even at high prices, because they assume it will just be more expensive tomorrow.
Exactly. The inflation becomes baked into the structural reality of the economy.
It becomes a wage price spiral.
Right. And the Fed minutes released this month explicitly highlighted this exact fear. They noted that several years of above-target inflation is beginning to noticeably affect price-setting behavior at the corporate level.
So central banks can tolerate a temporary volatile spike in prices caused by a war, but they absolutely cannot tolerate a permanent upward drift in inflation expectations.
Because once the psychology changes, it takes a brutal, deep recession to break it.
And you can see that terror reflecting in the shifting internal consensus at the Fed. This isn't a dovish, accommodative Federal Reserve anymore. We are witnessing a massive hawkish shift.
The numbers are pretty stark.
According to the latest data, 9 out of the 19 Fed officials now see a legitimate case for a rate hike this year. Think about how wild that shift is.
That's a huge pivot.
Just 6 months ago, the entire market was obsessively trying to guess how many rate cuts we would get in 2026. Everyone thought we were gliding down to lower rates. Now nearly half the Fed is staring down the barrel of a potential rate increase to try and break this inflation psychology.
And what makes this shift even more impactful is how Kevin Warsh is communicating it. Or rather, how he is not communicating it.
Right.
Warsh has paired this hawkish pivot with a radical historical overhaul of how the Federal Reserve speaks to the public and the markets.
This is the death of forward guidance.
Precisely. For the last 15 years, under Ben Bernanke, Janet Yellen, and Jerome Powell, we lived in the era of forward guidance. The Fed would essentially telegraph their policy moves months, sometimes years, in advance.
And they did it intentionally, right, to manipulate the bond market without actually having to change the overnight interest rate.
Exactly. If Powell went to a microphone and promised that rates would stay low for 3 years, bond traders would immediately price that into the 10-year yield, which kept borrowing costs low for the broader economy.
It was a tool to reduce volatility. The Fed acted like a helicopter parent for the stock market.
They held the market's hand, constantly reassuring traders that there would be no surprises. If the market threw a tantrum, the Fed would step in and soften their tone.
It created a psychological safety net, the Fed put, right? The assumption that the central bank would always intervene to stop a severe market crash.
And Warsh has completely scrapped that playbook.
He took the traditional, agonizingly long, heavily scrutinized policy statement, the one that Wall Street algorithms used to parse word by word to find hidden clues, and he replaced it with a 130-word summary.
130 words. It's basically a tweet.
Here's the rate. We will watch the data. Goodbye.
It is a generational shift in central banking philosophy.
But let's bring this down to the listener. Why should someone commuting to work or walking their dog care about the word count of a central bank press release?
Yeah.
Why does the death of forward guidance matter to a regular investor?
It matters because of what that brevity signifies for your portfolio. By killing forward guidance, the Fed is fundamentally changing the rules of the financial system.
Wow, so?
They are essentially looking at the stock market, looking at the geopolitical chaos in the Middle East, looking at the AI boom and saying, we don't know exactly what will happen next. We are entirely data dependent month to month. We are not going to make long-term promises we might have to break, and we are no longer going to hold your hand.
They are kicking the market out of the house and telling it to get a job.
Exactly. And when the market loses that helicopter parent, it is forced to price in much more risk and uncertainty.
Because they can't rely on the Fed to save them.
Right. Traders demand a higher risk premium to hold assets when they don't know what the Fed is going to do. That inherently makes overall financial conditions tighter, which slows the economy down without the Fed even needing to hike rates. It introduces volatility back into the system.
So put yourself in Kevin Warsh's shoes for a second. You're sitting at the head of the big mahogany table in Washington. You are looking at the two massive opposing forces we started this deep dive with.
Okay.
On one side of the ledger, you have this structural artificial intelligence revolution. It promises incredible productivity gains over the next 5 to 10 years. If AI allows one worker to do the job of 3, That creates a massive deflationary force that should naturally bring down inflation by making the entire economy vastly more efficient.
The technological savior narrative.
Right. But on the other side of the ledger, you have the brutal reality of today. You have 89.9 oil. You have a burning LNG tanker in the Strait of Hormuz. You have construction costs soaring and mortgage rates creeping back towards 7%.
It's a nightmare.
So the dilemma is, do you trust the medium-term promise of AI to eventually save you and bring inflation down organically? Or do you aggressively fight the immediate, painful reality of the oil shock right now, knowing you might crush the economy in the process?
The reality of monetary policy is that you rarely get to trade on the 5-year horizon when the building is on fire today.
So oil wins.
Oil is currently winning the argument. The productivity story of AI is absolutely real. The capital expenditures prove it, but it operates on a medium-term horizon. AI might cure inflation in 2028, but Hormuz is choked off today.
The average consumer cannot pay this much elevated grocery and gas bills with the promise of abstract AI productivity gains 3 years from now.
And central banks, bound by their political realities and the threat of inflation psychology, are being forced to react to the pain of today.
We have covered a tremendous amount of ground today. From the macro data of the IMF, to the trading psychology of the G10, to the micromechanics of the UK mortgage market.
It's a lot to process.
But I want to synthesize all of this into a clear, practical framework for you, the listener. How do you actually apply this intelligence?
If you take one overarching lesson away from this deep dive, it should be a recognition that the macroeconomic narrative has violently and rapidly shifted.
Yeah.
For the last year, everyone in the financial media and on Wall Street was playing the soft landing trade. The assumption was that inflation would smoothly glide down to 2%, central banks would gently cut interest rates, and we would avoid a recession.
A Goldilocks scenario. Not too hot, not too cold.
But we are no longer in that trade. The soft landing is a luxury of peacetime. We are now firmly in the oil shock trade.
And the practical application of that shift means preparing your personal finances for a higher-for-longer reality. Let's make this concrete. If you are an investor looking at your 401k or your personal portfolio, you have to factor in that the era of zero interest rate policy is dead, and the Fed put is gone.
You need to stress test your asset allocation against sustained inflation.
And if you are a prospective homebuyer sitting on the sidelines waiting for mortgage rates to magically drop back to 4% before you buy, you might need to fundamentally adjust your timeline or your price expectations.
Because the global markets, and by direct extension your local borrowing costs, remain entirely at the mercy of geopolitical choke points.
And the central banks have openly admitted they cannot control those choke points.
No, they can't.
Which brings us to a final, slightly terrifying thought to leave you with, pulled straight from the warnings buried deep in that IMF report. We spent this entire hour establishing that the AI, the semiconductor exports, the data center buildouts, the massive tech valuations, is essentially acting as the sole load-bearing pillar holding up the global economy against the crushing weight of the Middle East energy shock.
Correct. As the IMF data showed, without the AI hardware exports, the aggregate global growth numbers would already be contracting.
So we view AI as the savior, but what if that massive concentration of equity gains in AI-exposed sectors isn't just our salvation? What if it is in itself a massive systemic vulnerability?
It is the ultimate double-edged sword. Because the current stock market valuations of these AI and semiconductor mega-cap firms embed a scenario of flawless, sustained, and massive productivity and profitability gains.
They are priced to perfection.
Quite literally. Wall Street assumes the growth curve will only go up.
So imagine the alternative scenario. What happens if the physical deployment of AI hits a roadblock? What if the power grid literally can't handle the data centers? Or what if the actual corporate profitability of using AI doesn't materialize as fast as Wall Street demands?
If AI fails to meet those sky-high perfect expectations in the next 12 months, we won't just see a contained tech sector correction where a few stocks lose value.
We could see a brutal, severe tightening of global financial conditions.
Trillions of dollars in market capitalization could evaporate. And if that happens, it breaks the absolute last pillar holding the global economy together.
If the prosthetic leg of the AI boom snaps, while the heavy anchor of the energy shock is still pulling us down into the water, the economic tug-of-war ends. And it doesn't end in a way anyone wants to see.
The paralysis in the markets right now is entirely justified. The margin for error is essentially zero.
We started by talking about how investors are always looking for that clean, single current in the economy, the simple X-ray showing the clean break. But right now, we are navigating incredibly muddy, turbulent waters. We are caught exactly in the middle between the gravity of a geopolitical crisis and the soaring, precarious expectations of a technological revolution. So keep your eyes on the shipping lanes in the Strait, and keep your eyes on the quarterly earnings of the tech sector, because the collision between these two forces is only just beginning.